And then finally, I just want to, on the crypto side, address a question that we've been getting quite frequently. You can tell how convinced we are that deflation is the higher probability. And we know that's way out of consensus, and that's where we like to be. But many wonder how we could be positive at all about Bitcoin if we're not worried about inflation. Well, I think 08, 09 is a very good reason why. Why did 08, 09 almost melt the financial world down? It did so because of counterparty risk. And what we've just seen in the crypto market is really interesting. It's been cut in half, 2 trillion to 1 trillion, the ecosystem, in the last few months. Just cut in half. Can you imagine what would happen if our equity prices, bond prices were cut in half in the span of a few months with all the leverage out there? I think we'd be in a counterparty risk problem again, a big mess. Maybe not as big of a mess as we were in 08, 09, because there have been some changes. But I do not believe that our financial world would withstand a 50% drop as easily as the DeFi world has. DeFi, while a lot of people who were leveraged 100 times elsewhere in the world were wiped out. I think, I'm going to get this number wrong, it was either 86,000 or 860,000 accounts wiped out. DeFi didn't skip a beat. I don't think we could say that for the traditional financial world. And I do think that's why the shift towards DeFi, helped now by central banks moving into stable coins and legitimizing digital currencies, even though that's very different from Bitcoin. I do think we're going to accelerate further and faster into the DeFi world. And that too is very exciting. And as you know, if Bitcoin's price on a trend basis, remember, we're still a triple since last September. We may have been cut in half, but we were still a triple since last. And if the price continues to move up, what does that mean? That means increased purchasing power, which is what deflation is. So very consistent with our view of the world. And now on to the markets. As we've said all year long, this bull market has strengthened. It has deflected all kinds of bad news. The doubling in interest rates in the first quarter, the Archegos leverage blow up in the ecosystem, which many thought could cause systemic problems. We've been through tax hike discussions, which sounded pretty onerous in terms of their impact on capital, and we've seen a big correction. We certainly were right in the middle of it in valuations as those interest rates went up in the higher valuation side of the market, particularly if one is looking at valuations as of this year on this year's earnings. So we're very happy at the way the market has performed. It's up double digits. And we've seen now a shift, a rotation back from value as some of these prices have started to unwind, the commodity prices in particular, towards growth. But I think we're going to see toggling back and forth until some of the confusion that I'm discussing here dissipates. What's clear is profit growth right now has been or is explosive. I think for the second quarter, at an annual rate, the S&P is annualizing earnings at $220. So that's roughly 19, 20 times really effectively trailing earnings. And if we think earnings are going up, and we do, then the multiple looking forward is moving down into the mid to upper teens. That is good valuation support given the level of interest rates. But if we're right, and there is an inventory cycle brewing here, and there are wage pressures brewing. I mean, we hear headlines of all the labor shortages, and in fact, the JOLTS index, so that's the job openings index, it shot up to an all-time high, another all-time high. 9.3 million jobs are just waiting to be filled. There is either a skill set mismatch, or the wages are too low. And so we are seeing a lot of industries increasing wages to try and attract labor. Now, we do have many people still out on their stimulus checks until the end of September. That's in the lower wage categories. So that supply will come back in, and JOLTS, that number, 9.3, will go down. So that could take an edge off of the inflationary ramifications and the margin pressures associated with wages. And I do believe if we do go through this inventory cycle, and we see some profit pressure caused by costs, especially wages, that the market will become more discerning. I think that this shift towards growth will gain more momentum if this happens, because cyclical earnings growth will provide less competition. I do believe that what's going on in the bond market, this big surprise, it's really the flip side of the surprise that I witnessed when I first started in the business in the late 70s. I remember I used to deliver, and everything was by hand. There were no computers. In the late 70s, I used to deliver the inflation reading it was the first or second Friday of every month. And my boss at the time just didn't believe the inflation numbers, but the bond market was getting it right. He just didn't believe that the numbers were right and thought they would correct and that the interest rates would come back down. I think we might be on the flip of that right now. The bond market is signaling there are more deflationary pressures brewing out there, we believe, than most investors appreciate. I've just mentioned the good deflation associated with innovation, but the other side of that is creative destruction and the deflation that will hit companies who have leveraged up to buy back shares, manufacture earnings growth, have not invested enough in getting ready for the new world. And believe me, every sector is going to be transformed. And so they will face significant pricing pressure as their products really go obsolete eventually. And then the cyclical deflation. Well, the bond market seems to say this is what's happening. And if that is true, because most people don't believe 1.5% is a real interest rate, they've been normalizing, I think, in terms of the way multiples have worked out in the market, the equity market. They've been pricing or valuing stocks as though the normalized interest rate is somewhere around 4%. What if it's not? What if it is half of that? That would be huge for secular growth companies. Especially because there's going to be so much confusion. You have all of this innovation, which is going to be very exciting. And then you're going to have all of this destruction, which is going to be pretty demoralizing. It's going to be so important to get on the right side of change. So, part of our mission and value is to educate. We know robots are coming to satisfy or to take care of wage inflation problems. Today in our brainstorm, we're talking about robot picking strawberries. And big debate about that. Are we ready for it? Are we ready for it? I think we believe we're ready for it. On the oil price side, the antidote to that, electric vehicles at an accelerated rate, almost a self-fulfilling prophecy if the oil price keeps going up.